I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, real conversations to help high earners make sharper decisions so their money works as hard as they do. This is episode number 44, and today I'm joined by Kevin Bupp to discuss the cash flow power of mobile home parks and parking garages, and how to spot the right operators before investing. Before we dive in, make sure you're subscribed on your favorite platform. And if you find the show valuable, I'd really appreciate you leaving a quick review. Thanks so much and enjoy.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. Kevin, thanks for joining the Making Sense of Your Money podcast. Pumped to have you today, man.
Hey, Dan, thanks for having me here. I'm excited to be here, my friend.
Yeah, likewise. I'm intrigued by your background, and I know you've spent a long time in your space, and I think it's going to be one that really resonates with our audience, specifically around the cash flow nature of what you do. Let's start off by just giving our audience a little bit of your background and what you do and how you help people.
Yeah, no, sounds good. And I've always been a real estate guy. I always joke and say I've never really had a real job. I got introduced to real estate back at the age of 19. I bought my first investment property at the age of 20. At the same time, I was tending bar in the evenings, going to school, and just found that real estate was something that I was excited about. I could wrap my arms around and offer me the ability to make quite a bit of money. To me, what were large amount of large checks at a fairly young age, and so I just went all in. I kind of put all the chips on the table and started buying rental property and just really haven't looked back. So I've over the years, now 2+ decades, I've owned just about every type of real estate. Started with single family investments like a lot of folks do. Evolved over time, started buying apartment buildings, and then have kind of dipped my toe in the water of various types of other commercial real estate, industrial, self-storage, assisted living, office, you name it. I've either owned it today or have owned it historically. But really the last 13, 14 years, we really had our eye on just two lanes. We try to kind of stick our course and not try to reinvent the wheel. And so I started buying mobile home parks about 14 years ago. And continue to buy them today underneath our company, Sunrise Capital Investors. And then the other vertical that we're focused in is parking, which is fairly unique in nature. Parking lots, parking garages. And so those are the two areas that we spend all of our time, energy, and resources in. So I'm a chief investment officer and principal of Sunrise Capital Investors, and we've got about $350 million of assets under management, and those two verticals I just mentioned there.
Very, very cool. Very cool. So I know a lot of our audience has either thought of or is actively investing in real estate in some way, shape, or form today. Why mobile parks and parking? What got you into those two verticals, Kevin?
Yeah, it's a great question. Mobile home parks came first, so I'll speak to that. I got my start and cut my teeth in, and I said single family, but it was really more along the lines of Class C, B- Class C single family. So affordable housing. I don't know if it necessarily had the coined identity back then as affordable housing, but that's what it is today, and that's what we know we have a massive shortage of. And so that was the demographic that I tend to always serve, and so I understand it very well. And so over the years, as I started buying apartment complexes, they were basically the same type of asset, 20, 30-year vintage assets that were really targeting that affordable housing bucket. And so that it seemed kind of second nature and just an evolution to go in the mobile home parks. I mean, that's exactly who we are. That's who we're servicing. Those folks that they want to be in the good school districts, they want to raise their families in clean, safe, and quiet communities, but don't necessarily have the financial capacity to own a stick-built home in the area code or the zip codes that they currently live in. So mobile home parks afford them the ability to live the American dream and still live in the good part of town and again have their kids go to the good public schools and what have you. So I kind of stumbled into the mobile home park space. It wasn't on purpose by any means. I just happened to meet a gentleman, years back that owned a few, and I had a conversation with him, and I was so intrigued by it, and it seemed such a good fit for what I already knew and what I had already had been doing for 10+ years that I figured I'd go buy one and test the theory out. And so And that's what I did. Back in 2011, I bought that first mobile home park. Wanted to either prove or disprove all the great things I had heard about the asset class. And that first one turned into 2, turned into 3, and now we've owned and operate over 50 communities throughout the U.S. and it's been a fun run. So and again, it's very rewarding as well. We get to do good financially while helping those that really need a clean, safe, and quality place to live and raise their family and call home. So it's rewarding on both fronts.
Yeah, there's a lot of similarities to what I do in that front. And one of the things I love about what we do is being able to, run a high growth business, but do it while you're helping people along the way, which I think is a really cool concept. So let's unpack mobile homes and mobile parks a little bit more. What makes them, I understand from the end user's perspective why they might be attractive. You did a good job of laying that out. But from an investor's perspective, what makes them different than your traditional either single family dwellings or, apartment complexes or multi-unit spaces?
Yeah, no, it's a great question. And they're probably the most similar to a multifamily property. Just think of it as a horizontal apartment complex with a few unique differences. One of the big ones being is that typically we do not own any of the mobile homes. We own the entire community. We own the infrastructure. We own the land. So roads, water lines, sewer lines, common areas, clubhouse, amenities, if there are any. And the residents actually own the mobile homes, and they essentially pay a monthly lease, sometimes annually, but typically a monthly lease rate to lease that plot of land. And so they don't have property taxes. The home that they put there it's what classifies chattel. So it's personal property, just like your vehicle would be. It's tagged in the same manner. Every state handles it differently, but it's a personal piece of property, and they pay a registration or an annual type of a tax on that. They don't pay property tax. We pay the underlying property tax, but they pay us a monthly fee to reside there. And the unique thing about that is that while they're called mobile homes, they're not very mobile. And about 98% of these mobile homes that leave a factory, where they were made and end up in a community, never leave the community. There's quite a process to get them set there. They get blocked, they get anchored into the ground. It's fairly costly in nature. And so what tends to happen is if someone that lives in that mobile home, if they, decide to move, they normally just put that home up for sale like you would a stick-built home. They list it with a realtor, pull up, for sale by owner. They continue paying the lot rent until they find a buyer, and then they move. New buyer moves in, assumes the financial responsibility of the lease payment, the ground lease payment. And so, from an investor's perspective, there's quite a bit of stability there. These homes don't move out, and so you don't have the normal turnover that you might have in an apartment complex. When someone moves out of the apartment complex, you typically have a down period where you have to probably go in and do some renovations, carpet, paint, drywall repair. You might also have a month or so of once you have that unit ready, showing it to new prospective tenants. So you've lost a few months of financial revenue, whereas in our model, that's typically not the case. So it's just a much more stable business model. And then on top of that, these folks are homeowners that live in these mobile homes. They're very akin to that of a single family subdivision. This is their subdivision. They live there. We've got folks that have lived in our communities for 50 plus years, and sometimes there's generational, multi levels of the family hierarchy that live in one community, just like you would in a neighborhood. And so they're very sticky residents. They stay for the long term. They've got pride of ownership. They typically take care of their unit. Whereas like if they're renters in an apartment, I'm not saying that renters damage units, but they typically don't really invest too much into the space, right? Because it's just a temporary dwelling for them, before they move on to somewhere else. And so it's an incredibly stable business model. And then the last piece I'll make mention of from an investor's perspective on why it's so attractive is that for really two reasons, new mobile home parks don't get built. In fact, it's one of the only asset classes that has a diminishing supply. And so there's more mobile home communities that get redeveloped or shut down on an annual basis than new that come out of the ground, that new product, that a new supply that comes to the marketplace. And so one being, they tend to have a bad reputation. We kind of get lumped into a bucket that all mobile home parks are bad, and that's just not the case. You've got the ones that are on the wrong side of the tracks. You've got the ones that are in the night, just hardworking neighborhoods, and you've got some actually really nice higher end lifestyle communities. For some reason, we get in municipalities' eyes, we get lumped into the bad bucket, and so for that reason, it's very difficult to get new zoning approval. And then the other piece is it's just not as advantageous for a municipality from a tax perspective to essentially approve zoning for a mobile home park, because it takes up a large piece of land. And remember, these folks are not paying your typical, real estate property taxes that, that an individual would that would have a deeded piece of land and a single family stick built home on it. And so the municipality could do just about anything else and probably get a higher tax basis from that piece of land than that of a mobile home park. And so for that reason, those two reasons, you really don't see new ones get built. So you got the supply demand imbalance that is very significant in nature and advantageous for investors.
Super interesting. So I'm struck by like the combination here from the actual, the actual tenant's perspective. They're almost a homeowner and a tenant at the same time. They own the dwelling, if you will, but they rent the land. And I can see why the sort of the shortage in supply. So that begs the question, Kevin, how do you find these opportunities? Are you and your team typically buying existing mobile plots, or are you developing them and taking a plot of land and turning it into it, or have you done both over the years?
Yeah, and so the first is primarily what we do is buy existing, and as I mentioned, it's very difficult to get approval for new builds. In fact, last year there were 6 mobile home parks built throughout the entire country, and so new development is just not common. It doesn't happen. It's very risky, and again, even if you could get approved, in a piece of land rezoned, to build a new mobile home park, then you've got lease up risk and things of that nature, or sale risk, selling these homes, just like a subdivision, right? You build a subdivision out in phases. It takes time to actually start getting cash flow. And so we're really focused on buying existing properties. For the most part, we like to buy assets that are in great markets that historically have been owned by maybe a mom and pop owner, a legacy owner that's owned them for 20, 30, 40 years. That's a pretty common profile of our seller. Maybe they weren't the original developer, but maybe they're second in line, third in line, and they just own it for quite some time. And what we tend to find is that they stop really pouring a lot of capital back in. They don't do a great job of setting forth, capital improvement budgets on an annual basis. And so these things just tend to get tired over time. And so we can go in, we can breathe new life into them. We'll redo infrastructure, put new roads in, upgrade amenities, build playgrounds, build, clubhouses, just create a better lifestyle for the residents that are living there. And we can, in turn, operate them a lot more efficiently as well. We really run them like a true business rather than that of how a lot of mom and pops do, where, they might not have great, qualification standards for new residents moving in. They might not do a great job of collections. They might have some payroll inefficiencies with staffing and things of that nature. So we buy existing products that we know that we can improve upon and add a lot of value to.
Got it. And what type of staffing does it take to effectively run these types of properties?
Yeah, it's a great question. It can range from as little as just one person on site. So every one of our communities has an on-site staff. I would say up until about 150 sites in size, we would have a full-time community manager. So 40 hours a week, one individual that's essentially handling, the collections, handing out notices, dispatching, repairs and maintenance calls, handling vendors, things of that nature. Above that, we might add an assistant manager, part-time assistant manager. But I'd say the largest community that we have is about 700 sites. And that one has, I think, 7 total full-time staff. And so it's got a full-time community manager, 2 assistant managers. We've got 2 sales and leasing agents. And then we've got, I believe, 1 or 2 full-time maintenance staff as well. So that's about the two sides of the spectrum, 1 to maybe 7 or 8 on the largest scale. So,
all right. So let's talk about like the financial side of these. What makes a good deal in this space? And then how are you managing either investor cash flow, your own cash flow? Tell us like give us a little bit of a look under the hood of like a deal and like some of the return expectations.
Yeah. And again, a deal can be defined by how I define it's going to be very different than maybe how someone else defines it, right? We have certain metrics that we want to hit for our investors and for our funds that we have. And so for us, we want to know that upon stabilization, which typically, most of the communities that we buy, it will take anywhere between 1 and 2 years for us to really get it to a point to where we feel it's financially stable, whatever that means, whatever we have to do to get it there. It could be a litany of things. We want to know that we're getting, somewhere in the realm of an 8% cash on cash return from that property, and that over a 5-year hold, we're able to achieve roughly a 16 to 18% internal rate of return. So those are that helps us define the general buy box. But it's more than just that. I'd say before we even start looking at financial metrics, we want to know that we are in the right location. I mean, location is everything in real estate. So location always comes first. We can hit those financial returns and metrics in a lot of areas across the country that we would choose not to buy in. We want to be in areas that truly have a massive shortage of affordable housing. It's a national crisis, but it's emphasized in some markets more than others. There's certain parts of this country where it's actually pretty affordable still to live. You can live in many areas of the Midwest fairly affordably. And so we want to buy in markets where, median home prices are $250,000 plus, where, a two-bedroom apartment will rent for over $2,000 a month. Knowing that we can go in there and we can breathe new life into these communities, and we can even take a really bad element that might exist there. Like it might have just been run horrifically for 2 decades, but we can clean shop because we know that there are a litany of folks, endless amounts of folks that if we clean it up and do a good job, they'll be waiting to move in because there's nowhere else in that local marketplace that they can afford to live in a place such as that. So again, general overview of what we're looking at. As far as how we look at cash flow and how we operate our funds, I mean, we're pretty standard in nature. If someone's listening in here and they're familiar with real estate syndications, basically we run a model. We've got a preferred return structure in place, and that varies from 8% to 10% depending on how much of the capital investment you place. And then essentially it's a 70-30 split, 70% to our limited partners, our passive investors, and 30% to us. But that's only after we actually do a full return of capital and make up any of the accrued preferred return, which on our general partner side, historically what it's taken us is roughly 5 to 6 years to do a full return of capital and catch up on any preferred returns that have accrued over that period of time. And only at that point do we actually participate in the in the carried interest of the investment.
Got it. Okay, makes sense. Do you focus on any specific geographies? Or are you looking across the country really for that dynamic of high quality of living, but lack of affordable housing, if you will?
Just from a logistical standpoint, we tend to stay on the eastern side of the Mississippi.
Okay.
We've got, quite a bit of communities in the Southeast as well as the Northeast, and then we've got a few in the Midwestern states. But we only own one property today that is on the other side of the Mississippi, and that's actually a parking investment. It's a parking garage, and that's in Phoenix. But for the communities, we want to have some type of efficiency with our staffing. We've got a full property management team that's vertically integrated. So we've got president of operations, then we've got regional vice presidents underneath him, area managers that travel, around these different communities and that oversee these community managers and their staffing. And so, we're spread out, but if we were more spread out across the entire country, where we've got something in Washington State, something in California, something in Arizona, something in Montana, as you can see, it gets fairly cost prohibitive to be traveling around. It takes up a lot of time, and so for that reason, we tend to concentrate our efforts on the eastern half of the U.S.
Makes sense. All right. So you mentioned parking. Let's shift gears to the second aspect of your business. Tell me a little bit about what you look for there, and what are the how does that compare as an investment to the mobile homes?
Yeah. So it's all about cash flow again. Kind of the same thing. And parking investments, it's a very fragmented industry, just like mobile home parks. Lots of mom and pops, lots of old legacy owners that own these properties. And so for parking, it's slightly different as far as location. We want to be in urban core, high growth markets. I mentioned Phoenix. We own a property right in downtown Phoenix. Phoenix is one of the fastest growing cities in the country. We just bought a property a couple months ago in Old Town, Philadelphia, a block away from Liberty Bell, Independence Hall, and all those local tourist attractions. We bought one end of last year across from the Spectrum Center in Charlotte, downtown Charlotte, or it's actually uptown Charlotte. So we really look for locations that are high growth markets, highly densely populated areas. And then we want to know there's some levers that we can pull going in and add value. We want to buy a stable asset, but that's got multiple value add levers that we can pull. And so a lot of those come down to pricing levers, just really seeing that there's quite a delta between where they're currently priced at today versus where the market is. There's also some additional technology that we put in place that allows us to run a dynamic pricing model, to where maybe historically the garage has always run just on a fixed pricing model where it's $2 an hour no matter what time of day you come, whereas we can follow supply demand time frames, and we can charge more when the demand's incredibly high and then charge lower when the demand's lower. And so we can adjust that and basically really, increase our yield quite a bit, sometimes double digits, by just putting some of those minor changes in place. And then some of the other simple ones that we do. We bought this garage in Philadelphia, and what we found is after surveying parkers there and in the local office buildings and the hotels that use our garage is that these folks hadn't upgraded the lighting for like 10 years. And half the lights were burnt out. They had old halogen lighting that, number one, was not energy efficient. Number two, wasn't very bright. And so folks did not feel safe after 6 o'clock or 7 o'clock in the evening parking there. And so we had seen a drop off on the P&Ls over the period of like the last 6 years. And honestly, we attributed a portion of that to just the lighting. So we've upgraded the lighting, cleaned it up, restriped lines, and we've seen a massive rebound just over the last 4 months from just doing those minor things. So it's some simple things. But how we look at parking is this: it's got to be cash flowing day one. We got to be able to pull leverage. But I think the most important thing that excites us about this asset class is that everything that we purchase is below replacement cost. You would not be able to rebuild any of these parking structures in today's world with the cost of labor and material for what we've paid. And so it's somewhat irreplaceable real estate. And then second to that, we want to know that we have air rights, and we want to know that the use today as parking is the lowest use that it will ever be, meaning that it will only ever have a higher and better use at some point in the future. It's parking today. It could be parking for 10 years or 15 years, but at some point in time, that piece of land, that parcel of land in this densely populated urban core will have a higher and better use. And so we don't underwrite that future, but we know that it will be there inevitably. But until that point in time, we can cash flow and do quite well with using it as parking, as its current use. And so it's kind of a, great asset today, but it's got a very bright future at some point, whether it be a decade or 2 or 3 later on.
Very cool. Well said. All right. So you've been in all aspects of real estate now. So I think this is an interesting question to ask you. Put yourself in the investor's shoes, right? So sort of, you've been the chef, so to speak, helping to source these deals and understand what makes them good investments. If you're an investor that's looking to invest in real estate, maybe you're already doing so lightly, maybe you're doing syndications, maybe you've rented a few properties, whatever the case may be, how would you be evaluating which verticals of the real estate industry would be best to invest in based on your specific investor profile?
Yeah. It's a great question, and and I can speak from the other side of the table. I've got a number of investments with other groups that run different types of property. And so I will say that it's not a function of what asset class or, what's the best vehicle today. Is it parking? Is it mobile home parks? Is it multifamily? I think that they're all great in their own way. And I think you can make a lot of money and make great returns on any asset class, even office, right? Office is really been frowned upon, but it's turning around. There's a number of markets where it's kind of seen its bottom. You're able to buy office properties, some opportunistic funds that have rolled out, big institutional groups that have rolled out, $500 million, $1 billion funds to buy office now, because inevitably it will have a rebound. It might not ever be pre-COVID levels, but it will. And so I think it's more about the operator, the sponsor that you're investing in. It's kind of the jockey, right? Not necessarily the horse. And so I think I think you really need to look at it from that perspective and understand who's running the show, how long they've been doing it, what's it look like. So we're kind of in a cycle right now. We just went through some of a low point. Rates went up to all-time highs at a incredibly fast pace. A lot of investment groups found themselves in challenging situations. 2008 was another time frame. So I think you really need to look back and look at the track record, look at the reputation of the group you're investing with. How have they managed good times? How have they managed bad times? What's their communication like? Talk to other investors that have capital with them. And find out what their experience has been. It's not about, when things are going great. It's about like when things are not going so great, when you have not so great news. And I don't care how great of an investment group you are, like you're going to have a period of time where there's not so great news that you need to share with your investor base. And like, how do you communicate? How often do you communicate? How effectively do you communicate? Like, those are all important things that you want to look for. How strong is the balance sheet of the investment group that you're looking at? Forget about all the beautiful marketing material and the pro formas, because the one thing I can promise you about a pro forma is it will never be correct. I don't care how stellar of a track record a group has, it's either going to exceed expectations of that pro forma or it's going to miss it. Sometimes miss it more. It might just really fall short. So really understand the person that's running the show there, and get in alignment with them and make sure that you're comfortable with them and their track record and history and balance sheet and all those things, and forget about the investment itself that they're focused. Because if they've got a winning track record and they've got a solid reputation for multiple decades, then I would say that your money's probably fairly safe, much safer than that as someone that's just getting into the business. Might have a great deal, might seemingly a great deal, but not necessarily have the decades of experience that go along with, kind of running the ups and downs of the market cycles and how to manage capital effectively and all those other things. So really, it's all about the jockey.
I like that. So the jockey is the team that you're hiring for whatever it be, the syndication, the group or whatever. And then the horse is the asset, right? So
that's right.
I kind of hear you saying is if you're passively investing in real estate, so let's take out the people that are actually doing the actual rentals day to day or managing the property. If you're passively investing, you would say that it matters probably a little bit less about the horse because, you can buy horses in a lot of different, racing parks, if you will, right? If that's but it's the jockey and being able to find the group that's going to provide you the best returns and stable yields, et cetera.
That's right. Absolutely. And then, if you're actively investing, if you're out there buying your own real estate, I think the kind of same thing holds true. I mean, you just, where's your expertise lie, and, again, you can make money in anything. It's just, do you understand it? Are you excited about it? And do you want to own, full accountability of actually seeing that business plan through? And so again, you can make money in any of these asset classes. Again, I'll make the argument that I think mobile home parks and parking are the best, but I'm a little biased.
Sure. All right, cool, man. Well, that's great. All right, we're going to shift gears now. We're going to get to know you a little bit better. So we're going to bring you on into the lightning round, Kevin, which is all about you just sharing the first thought that comes to your mind. I've got some questions for you. It could be a one-word answer. It could be a long, drawn-out thought or anywhere in between. You ready to roll?
Let's go.
All right. One meal for the rest of your life. What is it?
Steak.
All right. What's one tool or piece of technology, so it could be hardware or software, other than your computer or your phone that you can't live without?
I'd say from a company perspective, we leverage Slack. We're a team of 50 folks on an international level, and we can maintain communication effectively using Slack.
Yep, I do the same thing. Is your team pretty well spread out all over the place?
All over the place, all over the U.S., Mexico, and the Philippines. So yeah, we're all over the map. It's myself and the other principal of our group, Brian and myself, Brian Spear and me, that live here in Tampa. And then we've got about 70 other folks that live in the U.S. and about 15 that are international. So, but Slack is it.
Love it. Do you have a favorite quote or phrase about money or success?
Yeah, that's a good one. I mean, I love Warren Buffett. I love everything he's about. And I always mess it up. His rule is it's basically about not losing money, and don't forget rule number one is don't lose money. Rule number two, don't forget rule number one. Right?
Refer back to rule number one. Yeah,
that's it.
All right, I like it. This is going to be an interesting one because I see you've got a book behind you. But do you have a favorite book on finance or business?
It's about the only book I read on an annual basis. I reread it, and maybe not like the entire way through, but I definitely use it as a resource manual. And I've probably done it for like the last 15 years. Is Think and Grow Rich. And so it's not necessarily finance related, but I mean it's a classic, and there's always a golden nugget or lesson that you can pull out of it a second, a third, a fourth, a fifth time, sixth time around the moon, right? And so it's a great one, and it's probably one that I've gifted more than any other book to friends or family or colleagues, what have you.
It is an absolute classic. Couldn't agree more with that. I actually just did a LinkedIn post about that book a couple of weeks ago, so I like it.
Yeah.
Right, do you have either a personal routine or a hack that you could share with our audience?
Yeah, I don't know if I have a hack per se, but I feel I'm really into the health and fitness, and so you're really having a structured fitness regimen. Really starts my day off on the right foot. And I feel as though like the days where I happen to miss it, whether it be due to travel or something that just interrupts the flow and I can't get a workout in, are the days that I'm the least productive. And so I feel like I get 2x the amount of work done, maybe sometimes 3x on the days I can get a good workout in first thing in the morning. I get up before the rest of the family gets up. Normally wake up at 4:30 in the morning, get my workout in, get some quiet time, have a coffee, have a tea, and just kind of sit and prepare for the day prior to anyone getting up and the chaos starting in the household. Like for me, that works really well. The
I do
days
the
that it
same
doesn't
thing.
happen, the days I sleep, the days I get up when the kids get up and when my wife gets up and it's like chaos right out of the gate, are the days that are just, I mean, I'll get stuff done, but it just doesn't feel the same. You know, it doesn't feel that it flows as well.
You and I are similar on that. What do your workouts look like? What are you into from an exercise perspective?
Yeah, so I do a gym normally 4 days a week, but then I'm really into road cycling, and it's
Cool.
been a passion of mine for a couple decades. So 2-3 days a week I'll get out and crank out a couple hours early in the morning on the bike and just feel the wind through my hair and get out and smell the fresh air and listen to a podcast, listen to some music, and just really kind of zone out.
Love it. Yep. Can't beat that. I'm with you on that. It's a great way to start the day. I agree. What's one bucket list item you've already accomplished?
Yeah, that's a great question. Yeah, so when I guess probably when I was in my really early years, I grew up in Pennsylvania, and we didn't grow up wealthy. I mean, very middle of the road, blue collar. Both parents worked. And at the age of 10, my parents bought a little boat. I mean, a tiny little boat. We had a little river an hour away from us. We'd go, and they owned it for like 2 or 3 years. But that really turned on my love for the water and boating and everything that revolves around that. And so from that point forward, I was just enthralled with kind of living by a body of water. And so when I moved to Florida back at the age of 22, my dream was I love the ocean equal amounts as I love fresh water. And there's quite a bit of both freshwater lakes and the ocean down here. My dream was to have a property on the ocean, but also on the lake that was close by. And we were able to accomplish that in like the last 4 years. So we've got a little bit of both, and we get to experience, wakeboarding and water skiing and all that fun stuff on the lake about an hour away. And then we've got our home here on the Gulf of Mexico.
Awesome. Can't beat that. You got them. You get a little bit of both there. Very cool. All right. Last one. If you could give advice to your younger self, what would it be?
Yeah, I'd say surround yourself with folks that are smarter than you. I just literally had this conversation with my son this morning. He's and it's not as not somewhat a direct correlation of smarter than you, but he just got into tackle football this year, and
Nice.
literally they're going to states this week. I mean, like phenomenal. I mean, like undefeated, and are just absolutely killers. All the kids on there are great. He's 11 years old, and he's by no means the best on the team. He doesn't get a lot of play time, but I was like, this is an amazing experience to be a part of. And I know like
Sure.
it's a little bit frustrating. You're not getting your plays in. Like he shows up to practice, he shows up every day, but like there's some incredibly talented kids on that team. I was like, it's a good thing. Watch what they do, how they do it, why they do it. Talk to them about what they're doing. Talk to them about the plays, what they think. Get in their head. You definitely want to be around those that are way more talented. You just extract as much as you can from it. It's better than being the best on the team and just you not having anywhere to grow. Like you can't grow as an individual unless you're constantly being uncomfortable, and pushing yourself to be better and to live up to maybe a few others that are on your squad. So I think that applies to life. Whether it be friends, business, just be around those that help push you and push you to grow and be a better person.
I love it. Well said, man. Kevin, if our audience wants to connect with you, collaborate, learn more about you and your team, where can they find you?
Yeah, you can go to our website, investwithsunrise.com.
Cool.
We've got information about any available opportunities. We've also got a lot of quick case studies on there. We've got white papers that we share on kind of our investment thesis. Even if you don't have an interest in investing, there's probably some stuff there that you can grab that's free, that's informational. And then I'm pretty active on LinkedIn as well as Facebook and Instagram. But I'd say LinkedIn's probably where I'm most active. I wish I could say I don't give out my handle because it's different on each one of those social platforms. But my last name is unique enough. It's Bupp, Bupp. That if you just type in Kevin Bupp, I'm pretty sure I'm the only one that's going to come up that's a real estate investor. So
awesome. Well, that's great. Kevin, thanks for coming on, man. Appreciated having you and sharing your insights today.
Thanks for having me, Dan. Been a pleasure.
You bet. And that's it for the episode. You can find our podcast along with our newsletter and our YouTube channel all for free at makingsenseofyourmoney.com. And as always, prioritize your version of a rich life.